All right, Liz, thank you. The sharp decline in the price of oil has the energy sector reeling, really. Companies are cutting jobs, cutting spending. My next guest invests in the space. He sees more pain ahead. Joining me right now is Charles Cherington. He is Intervale Capital managing partner. Charles, good to have you on the program.
Thanks for having me.
When you say there's more pain ahead, are you expecting further cutbacks in terms of CapEx and cutbacks in jobs? What does that pain involve from your standpoint?
Yeah, the fundamental problem right now is that supply exceeds demand by a considerable amount, number one. That's in terms of worldwide oil market dynamics. And number two, production in the U.S. is going to increase probably through the duration of this year. Rollover in production is expected sort of Q4 of 15, Q1 of 16. So before things get better, they're going to get worse, and they'll get considerably worse in the first half of this year. We already have inventory levels in the U.S. for oil that haven't been seen in 80 years. And every week we're seeing substantial increases to that inventory. So what's going to happen is there'll be continued reductions in CapEx for the oil companies. There'll be continued layoffs by both oil companies and service companies. And I would expect further downward revisions in CapEx and activity to be announced by oil companies over the course of this year. And
this is largely then a supply issue. Bottom line is there's too much oil at this point, given the Americans are producing, Libya is producing, Iraqis are producing. Is that the main issue?
It's a couple of things. I mean, first of all, there's obviously excess supply in the system. It's always remarkable when you get into a situation where oil drops 50% and there's not a real demand response. So demand itself is quite anemic. Demand is inelastic, so there's no immediate response from the demand side. Obviously, the reduction in the price of oil is like a massive fiscal stimulus for the U.S. economy, so there'll be a second-order effect sort of down the road where people have a little more income and might spend a little more. But at the end of the day, oil demand might go up 1 million barrels a year, 1 million barrels a day this year, excuse me. And at the same time, you've got probably 2 million barrels of excess supply in the system today and another 700,000 or so on the way from the U.S. So you can see it's going to take quite a bit of time for markets to balance.
So in terms of investing around that, are there valuations that have come down enough that are actually opportunities here? How do you invest then, knowing that, in fact, this is going to get worse?
Well, if you have a long-term view, oil will go back up. At the end of the day, long-term supply is going to be priced at the point where the sort of last barrel bought cost to come out of the ground. So if you look at sort of U.S. shale is costing, $80 a barrel roughly on a long-term basis to be sort of profitable and prosperous, that's where we're ultimately going to have to get. The U.S. is now the world's swing supplier. We've added about 4 million barrels a day of production in the last 5 years. There's 2 million barrels of oversupply. So we will ultimately be pricing that last marginal barrel. And now, as prices go up, obviously the valuations for public equities, whether it's service or E&P, is going to go up as well. The challenge is trying to figure out the timing on that. Again, it's not going to be in the first half of this year. It's probably not even until 2016, and things will get worse before they get better. So if you have a long time horizon, certainly it's a good bet to make. But that doesn't mean that you haven't seen the bottom yet. In fact, you probably haven't. And
how much lower do you think oil can go? What's your target on oil prices, Charles?
Very hard to predict the future and very hard to predict oil prices. At the same time, if you look at the fact that supply is increasing, demand is not really responding, there's no reason that prices couldn't go considerably lower. I mean, it's hard to put a precise point on it, but the notion that we've hit a bottom doesn't really make sense in the context of increasing supply and anemic demand.
All right, we'll leave it there. Charles, we'll be watching. Thanks so much for joining us today.
My pleasure.
We
Thank you.
appreciate it. Charles Cherington joining us on Energy. Next.